Today is Monday, February 9th, 2026, and the silver mining sector just gave us a signal that changes everything. Right now, silver is trading at $81 per ounce. It crashed from $121 just 10 days ago. The crowd thinks the rally is over, but here's what they're missing. The mining stocks haven't moved yet. They're still priced as if silver is sitting at $50. First Majestic is up only 8% this week, Hecla Mining 8%, Endeavor Silver 7.5%. These are tiny moves for companies whose profit just tripled. Let me show you the math that Wall Street is deliberately ignoring right now, and why March could rewrite the valuation of this entire sector. A standard silver miner has an all-in sustaining cost of around $22 per ounce. That's what it costs to pull the metal out of the ground. When silver was at $30 2 years ago, these companies made $8 profit per ounce. Decent business, nothing spectacular. Now silver is at $79. Even with inflation pushing costs up to $25 per ounce, the profit is now $54 per ounce. That's nearly 7 times higher. But the stock prices, they've barely doubled. Some are up only 50% from their lows. The market is pricing in a crash that hasn't happened. This is what analysts call a valuation disconnect. The fundamentals say one thing, the stock price says another, and that gap doesn't stay open. According to Momentum Structural Analysis, silver just completed what experts call a rebirth following the recent correction. Michael Oliver, the analyst who called the 1987 crash before it happened, is now projecting silver could hit $500 per ounce this summer. Even conservative targets put silver at $350 by March. And if that happens, the mining stocks won't just double, they could go up 10 times or more. Why? Because of something called operational gearing. When the product price rises, the profit doesn't rise linearly. It explodes exponentially. Let's run the numbers. If silver hits $350 and costs stay at $25, the profit becomes $325 per ounce. Compare that to the $8 they made 2 years ago. That's a 40-fold increase in profit per ounce. Mining stocks typically trade at 3 to 5 times their earnings growth during bull markets. Do the math. A 40-fold profit increase could drive stock prices 120 to 200 times higher. Even half that would be life-changing for early investors. Right now, the market is in denial. Investors think this is a speculative bubble that will pop like 2011. They're waiting for silver to crash back to $50. But this time is structurally different. We're not dealing with a Hunt Brothers manipulation or a retail mania driven by leverage on COMEX. This is a currency event. The dollar index just broke below 97. Central banks are devaluing at unprecedented rates. Silver is the thermometer. Industrial demand is also exploding. Solar panels, electric vehicles, AI data centers. These sectors cannot function without physical silver. And here's the critical part. Global silver production has run a deficit for 5 straight years. We're consuming 200 million more ounces than we mine annually. COMEX inventories just dropped by 3 million ounces in a single day. That's the kind of drain we haven't seen in years. Physical metal is leaving the system. At the same time, 100% of silver futures contracts are now settling for physical delivery. Normally, only 1 to 3% settle physically. This tells you something massive. Industrial users are bypassing the paper market entirely. They're demanding real metal because they can't build products with contracts. The Shanghai Futures Exchange is still pricing silver with a $10 premium over Western markets despite the recent crash. That's a regional supply crisis. Mining companies cannot respond to this demand quickly. It takes 10 years to bring a new mine into production. There's no cavalry coming over the hill. So we have inelastic demand colliding with inelastic supply, and the only variable that can adjust is price. It has to go higher, much higher. The institutions are starting to notice. Pension funds hold less than 0.5% of their assets in precious metals. If they move just 1% into silver, that's $500 billion. The entire annual silver production at current prices is worth less than $100 billion. You see the mismatch. The market is far too small to absorb that capital. When the floodgates open, and they will, the mining stocks will be the primary vehicle for institutional money, because you can't buy 800 million ounces of physical metal. This is the setup. The correction shook out the weak hands. The fundamentals are stronger than ever, and the stocks are still asleep, priced for a world that no longer exists. If you're watching this and you understand what I just laid out, drop a comment below. Tell me, do you think $350 silver by March is realistic, or am I missing something? And if this analysis is adding value, hit that like button. The algorithm buries content that tells the truth. Your engagement keeps this information flowing to people who need it. Let me show you what happened in the last major silver bull market, and why this time the move could be even larger. In 1979, silver was trading around $6 per ounce. By January 1980, it hit $50. That's an 8-fold increase in less than 12 months. But here's what most people forget. The mining stocks didn't just go up 8 times. Some of them went up 50 times or more during that same period. Hecla Mining, one of the oldest silver producers in America, went from around $2 per share to over $60. That's a 30-bagger in a single year. Why did the stocks move so much harder than the metal itself? Because of the profit leverage I just explained in the first part. When silver went from $6 to $50, the mining costs stayed relatively flat. Maybe they went from $4 to $6 per ounce due to inflation. So the profit per ounce went from $2 to $44. That's a 22-fold increase in profit, while the metal price only went up 8 times. The stock market multiplied those earnings by another factor of 3 to 5, creating the explosive gains that made fortunes in that era. Now let's compare that to today. Silver is at $79 right now. If it hits $350 by March, that's a 4.4 times move from current levels. But the profit leverage is actually stronger today than it was in 1980 because mining costs are a smaller percentage of the selling price. In 1980, costs were roughly 70% of the selling price. Today, costs are around 30% of the selling price at $79 silver. This means the profit margin expansion will be more dramatic when silver rises. The math favors even larger stock gains than we saw 45 years ago. And there's another factor that didn't exist in 1980. Institutional capital flows. Back then, pension funds and sovereign wealth funds weren't buying mining stocks. Today, these institutions manage over $50 trillion globally, and they're starting to realize that their traditional portfolio construction is broken. The 60-40 portfolio, 60% stocks and 40% bonds, doesn't work anymore. Bonds have lost 50% of their value since 2020, while gold tripled. Current allocation to gold in institutional portfolios is around 1.4%. If that moves to even 3%, we're talking about hundreds of billions flowing into this sector. But the entire market cap of primary silver miners is less than 20 billion. When that institutional money tries to enter, there's nowhere near enough supply. UBS just released a report saying they believe both gold and silver can move even higher in 2026. This is a major bank validating the thesis publicly. The state of Wyoming just started buying physical gold for reserves and selected a private vault over JP Morgan. That's a statement about trust in the system. We're watching a fundamental shift in how sovereign entities and large institutions view precious metals. They're not speculation anymore, they're strategic assets. The correction we just saw, the drop from $121 to $77, was not a breakdown in fundamentals. It was a leverage flush in the futures market. Shanghai futures saw 1.34 billion ounces traded in a single morning session. That's almost double the annual global mine production traded as paper contracts. This was systematic short selling designed to shake out weak hands and trigger stop losses. But the physical market told a completely different story. COMEX registered inventories kept bleeding. Physical delivery demand stayed at 100%. The London spot market went into backwardation, signaling tightness. When paper and physical markets diverge like this, the paper market eventually loses. You can print contracts, but you cannot print silver. Industrial users like Samsung, Tesla, and solar manufacturers don't care about futures prices. They need physical metal for production lines. And they're realizing that relying on just-in-time delivery from the spot market is a massive risk when supply deficits are running at 200 million ounces per year. So they're doing what automotive companies did with lithium. They're buying mining companies outright to secure supply chains. Vertical integration is happening. When a tech giant acquires a silver miner, they don't care about the current stock price. They care about securing the next 20 years of production. This dynamic puts a floor under mining stock valuations that didn't exist in previous bull markets. The stocks have strategic value beyond just financial returns. Right now, the market is pricing these companies as if silver will crash back to $50 and stay there. But every piece of data says the opposite. The deficit is structural. The industrial demand is accelerating. The monetary debasement is undeniable. And the supply cannot respond for at least a decade. If I'm right about $350 by March, the mining stocks are the most mispriced assets on the planet right now, and the window to position is measured in weeks. There's a pattern developing right now that veteran commodity traders are calling the most dangerous setup they've ever seen for short sellers. Let me explain what's happening behind the scenes at the exchanges, because this is where the real pressure is building quietly. The Shanghai Futures Exchange just announced new margin requirements for precious metals starting Monday. Daily price limits adjusted to plus or minus 20%. Margin requirements for hedging positions are now up to 21%. General positions up to 22%. They're tightening the screws because the system is under stress. Now, picture this scenario. You're a hedge fund that went short silver at $70 thinking it would crash back to $50 after the recent correction. Then a government or exchange sets a price floor at $80. What happens to your position? You're instantly underwater, not by market forces, but by policy. There's no pullback to cover your position. There's no dip to buy. Trading below $80 is no longer allowed. Your loss is locked in immediately. At $10 per ounce loss, that's $50,000 per COMEX contract. Margins get raised. Liquidity disappears. You either get a margin call or forced liquidation. And here's the truly terrifying part for anyone playing the paper short game. If physical silver is tight and delivery is demanded, your paper short becomes a physical obligation. You don't have the metal, so you either pay any price to acquire it or you cash settle with penalties. This isn't a normal short squeeze. This is a state-backed repricing event. A price floor doesn't protect short sellers. It eliminates them completely. You can short paper, but you cannot short a floor. The moment a floor is set, the old silver market is over, and we're seeing signs that multiple governments are considering exactly this type of intervention. Why? Because silver is now classified as a strategic resource with national security implications. The U.S. Treasury just held a ministerial meeting on critical mineral supply chains. When a metal becomes strategic, governments don't let free markets determine the price anymore. They intervene to secure supply for domestic industries. China has been doing this quietly for years. They've been accumulating physical gold and silver while keeping domestic prices elevated to discourage exports. That's why Shanghai maintains a $10 premium over Western markets even after the recent crash. They're not letting their metal leave the country at discount prices. This creates a two-tier market. Western paper markets where leverage games are played, and Eastern physical markets where real supply and demand set the price. Eventually, these two markets have to converge. And when they do, it won't be the physical market that adjusts down. It'll be the paper market that explodes up. Let's talk about what's happening with COMEX inventories, because this is the smoking gun that confirms the physical shortage thesis. On Tuesday, February 4th, 3 million ounces were removed from COMEX vaults. Not a misprint. 3 million ounces in a single day. Nearly 2 million ounces were withdrawn from Asahi. Over 900,000 ounces from HSBC. Another 282,000 from JP Morgan. This is metal leaving the system entirely. Total COMEX silver inventory dropped to 400 million ounces. That sounds like a lot until you realize global industrial demand consumes that much in less than 5 months. And here's the contradiction that should make everyone pay attention. While 3 million ounces are being pulled, 600 more futures contracts were issued delivery notices in just 4 days. That's over 3,500 contracts settling physically. 17.5 million ounces. Normally, 1 to 3% of contracts settle for physical delivery. Right now, 100% physical settlement. You cannot build AI data centers with paper silver. You cannot manufacture missiles with futures contracts. The world is desperate for the actual metal. Industrial users are bypassing the futures market entirely and calling refineries directly. We're hearing reports of premiums skyrocketing on 1,000-ounce bars. Delivery times that used to be measured in days are now stretching into weeks and months. This is what supply chain breakdown looks like in real time. The United States Mint announced a 1-month delay on 2026 American Silver Eagle coins. When they were finally released, they sold out immediately. Retail dealers like APMX briefly saw prices for bulk purchases of American Silver Eagles touch $99.69 per coin. That's a $20 premium over spot price. When premiums expand to that degree, it signals physical shortage conditions developing in retail markets. People want the metal, not the paper promise, and the mining companies cannot increase supply fast enough to meet this demand surge. Mining isn't like turning on a faucet. Discovering a new silver deposit, securing permits, raising capital, building infrastructure, and bringing a mine into production requires 10 years or more. Years of suppressed silver prices discourage the massive capital investment needed for new projects. Existing operations are depleting their highest grade ore bodies. Recycling, while helpful, cannot bridge a 200 million ounce annual deficit. The supply response isn't coming this year, next year, or even 5 years from now. This is the setup for what Michael Oliver describes as lightning form repricing. When markets ignore fundamental deficits for extended periods, the price adjustment doesn't happen gradually. It happens violently and rapidly as price catches up to where it should have been all along. The deficit was building while silver traded in the 20s and 30s. Now, with silver above $70, the deficit still exists. The market is only beginning to price in the reality of structural scarcity. And the mining stocks? They're still trading. Like this is a temporary spike that will reverse. They're wrong. The fundamentals say this is just the beginning. Let me tie everything together and show you why the next 30 days could determine who positions correctly and who misses this entirely. We've established that silver mining stocks are priced for $50 silver, while the metal itself trades at $79 and could hit $350 by March. We've shown the profit leverage math. A move to $350 doesn't just triple stock prices. It could send them up 10 to 20 times based on earnings expansion. We've documented the physical shortage, COMEX losing 3 million ounces in one day. 100% physical settlement. Shanghai maintaining a $10 premium despite the crash. And we've explained why supply cannot respond. It takes a decade to build a new mine. The deficit is structural, not cyclical. So what happens next? There are 3 possible scenarios, and I want to lay them out clearly so you can make your own assessment. Scenario 1. Silver consolidates between $70 and $85 for the next few weeks. The mining stocks slowly start to catch up as investors realize the earnings beat expectations. This would be the slow burn scenario. Stocks grind higher over months. You'd have time to position. But the gains would be more measured, maybe 3 to 5 times. Scenario 2. A major institution or sovereign wealth fund announces a strategic position in physical silver or acquires a mining company outright. This would trigger the melt-up. Other institutions would panic that they're underweight the only performing asset class. Capital floods in, stocks gap up violently overnight. In this scenario, you don't get a second chance to enter. The bid-ask spreads blow out. Liquidity dries up. Prices jump 30% to 50% in single trading sessions. Scenario 3, and this is the one most investors aren't considering. Governments intervene and set price floors or restrict exports to secure domestic supply. If this happens, the paper market becomes irrelevant. Physical metal disappears from exchanges. Mining companies become strategic assets that trade at massive premiums to book value. Which scenario is most likely? I believe we're heading toward a combination of 2 and 3. Institutional flow plus government intervention. The signs are already visible. Wyoming buying gold and rejecting J.P. Morgan's vault. Treasury meetings on critical minerals. Shanghai tightening margin requirements. These aren't random events. They're coordinated moves by entities that see what's coming and are positioning before the public catches on. Now, let's address the elephant in the room. What about the risk? What if I'm completely wrong and silver crashes back to $50? Here's what the data says. Even if silver dropped to $50 tomorrow, the mining companies are still profitable at current stock prices. Most quality miners have all-in sustaining costs between $20 and $25. At $50 silver, they'd still be making $25 to $30 per ounce in profit. That's not a bankruptcy scenario. That's a business that prints cash. The stocks might pull back 30% or 40%, but they wouldn't go to zero. Compare that to the upside. If silver hits $350, and I'm right about the leverage, the stocks could go up 1,000% or more from current levels. Risk-reward asymmetry. Limited downside with massive upside. That's the kind of setup that creates generational wealth when you position before the crowd. But here's the critical part, and I want to be very clear about this. Timing matters. If institutions flood in next week, you're late. The flow has already started. Family offices are accumulating. Smaller pension funds are adding exposure. The sovereign funds are next. When Norway's oil fund or Saudi's PIF decides to allocate even 1% to precious metals miners, the game is over. They manage trillions. There won't be enough shares available to absorb that capital. Prices will gap, and you'll be buying from early investors at 10 times what they paid. I'm not telling you to do anything. I'm showing you the data and letting you draw your own conclusions. This is analysis, not advice. But if you followed the math, seen the COMEX inventory drain, watched the Shanghai premium hold, and understand the institutional flow dynamics, you know what this looks like. This is the early stage of a commodity supercycle, driven by currency debasement and industrial demand colliding with inelastic supply. The mining stocks are the highest leverage play on this thesis. They're undervalued, underowned, and sitting on the only future supply that exists. March is 30 days away. If silver hits $350 in that time frame, the stocks won't wait for confirmation. They'll move before the metal does. Front running is what smart money does. They don't wait for certainty. They position on probability and asymmetric risk reward. Right now, the probability favors a move higher based on every data point we've covered. The risk reward is heavily skewed to the upside. What you do with that information is entirely your decision. I'm just showing you what the institutions are seeing right now. Before you go, I need your perspective. Drop a comment and tell me, which scenario do you think plays out? Slow grind, institutional melt-up, or government intervention? And if you found value in this breakdown, hit that like button and subscribe. This is the kind of analysis that doesn't get covered on CNBC. The wealth transfer is happening right now. The only question is which side of it you'll be on. Stay sharp, stay informed, and I'll see you in the next one.